U.S. futures are pointing to a soft open at the open. There you see all three of the major contracts down. There's all kinds of debate, of course, in the marketplace about the Fed. Is it finished? And if so, when will it begin cutting interest rates? Joe Little is chief strategist at HSBC Management, and he joins us now. Joe, thanks a lot for joining us. You believe the Fed will likely cut rates in the second half of 2024.
Yeah, thanks, Paul. So, look, the big story in investment markets over the last couple of weeks has been the much better inflation data. Inflation is really falling at quite a big pace, not just in the US, across North America, in the UK, where I'm speaking to you from. We've also had some very strong, better than expected inflation readings, falling inflation trends, and also in Europe. So around the world, we are seeing a pattern of disinflation coming through, and that's connected to what we've seen on goods prices falling quickly. The idea of inflation being pretty transitory. After all, you might remember economists had a big discussion about the transitory nature or not of inflation. Well, goods prices have shown themselves to be rather transitory, and the central bankers are still concerned with services inflation. But I think as labour markets and housing markets begin to cool, that will also begin to dissipate. So, you know, the future's always uncertain, events can happen, trends can be a little bit bumpy, but as far as we can tell, right across Western economies, the trend is for lower and lower inflation and moving back toward target over the course of 2024. And quite rightly, as you say, that then creates the opportunity for central bankers to begin consider cuts to their rate stance, probably starting around the middle of 2024.
One thing that has really surprised many economists and investors is the strength of labor markets. Certainly in this country and in the United States, labor markets have really held up. You think they will weaken?
Yes, I think that's right. Although, of course, the economy has surprised us with its resiliency over the course of 2023. So you have to keep an open mind to these evolving trends. But as we look into the data, a lot of the leading indicators about the labor market, how vacancies are behaving, how temporary employment is behaving, some of the survey data that we have on labor markets is incrementally pointing to weakness now appearing over the next 3 to 6 months. So I think we will begin to see a slowdown and a continued slowing of labor market trends. And to a certain extent, that's already happening around the rest of the world. If we look at the data in Canada or in the UK, even in the US, we are seeing a pickup in the unemployment rates already. So I think that's telling us something about how the economic system is dealing with the consequences of policy that is restrictive and probably overly tight. So the Fed, the Bank of Canada, other global central banks have tightened interest rates aggressively to deal with that big inflation surge. And my worry essentially is that as that inflation problem has been fixed, there's some challenges that are posed to the growth cycle as well. And we're increasingly going to see those coming through in a weaker profile for labor markets, a weaker profile for economic growth, a weaker profile for corporate profits, which is particularly important for the stock market outlook as we move into 2024. And as you hint, Paul, my working assumption at this point is that we get cuts first from the Fed leading the way around the mid part of 2024, and we could possibly see maybe 2 percentage points worth of interest rate cuts over the course of the second half of 2024, taking the policy rate right down to 3.5%. As we go through next year. That clearly depends on the data situation and how those growth trends unfold. But the point is that once the inflation problem is dealt with, if that growth situation is deteriorating, the central banks clearly have some room to ease policy from what we regard as rather tight and restrictive rates at present.
I'm looking at some of your notes, and you say in the medium term, you use the phrase zigzag profile to describe what you think is coming over the medium term in inflation, with 2% being the bottom of the zigzag. Does that suggest that central bankers over the medium term will continue to have to wrestle and perhaps raise rates at certain junctures to keep inflation down towards 2%?
Yeah, it's a little bit complicated, isn't it, as a story? But essentially what we see in the near term now, maybe over the next 6 to 12 months, is a situation where recession risks are building, growth trends are slowing, and inflation trends are dissipating after that really big post-pandemic surge of inflation that we've been dealing with over the course of the last couple of years. So that's the near-term picture. But as you say, as we extend our thinking into the medium term, maybe for the second half of the decade, we think we're left with a bit of a new environment for the global economy, especially when we compare it with what we saw during the 2010s. The new environment is really one where we're seeing governments trying to deal with the existential challenges around the climate emergency. We are seeing the global economy, the global order becoming more multipolar, with many important shifts in terms of trade, and in terms of financial flows. And we're seeing governments around the world wanting to be more active. Industrial policy is really back with a bang. And the consequence of those three sort of themes is really to create a little bit more inflation in the system. And quite rightly, as you say, we used to think in the 2010s as 2% inflation as a ceiling. Central bank has really struggled to get inflation above that ceiling rate. But in the medium term now, it looks more like it would be a floor because of fiscal policy taking a much more active role in managing the economy. And consequently, we see a regime of somewhat higher interest rates and somewhat higher bond yields as well as we look ahead into the medium term. So disinflation and recession in the near term, an environment where bonds and fixed income assets can do quite well, but the longer term outlook is a slightly different environment, a slightly different situation, a new paradigm of somewhat higher inflation and interest rates.